Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, August 15, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And so we had a gap down today. We had a gap down and a go day, so it was a gap and go to some extent. The market did recover in the afternoon, but it was a pretty healthy down day considering across the board. So when you look at the S&P 500, we were down about 21, 22 points today. The the Dow Jones Industrial Average was down about 137 points. And the Nasdaq Composite was down 96 points or 1.23%, leading on the downside. Obviously, you know how I feel about the IWM, my favorite market leading indicator. That was also outpacing the S&P 500, so it was a leading indicator on the downside today. What was interesting was that we gapped below the 20-period moving average, even though yesterday we had what could be considered a trick, trap, fool, and frustrate day where the market looked like it wanted to work its way back upwards. We had that one day down. The media pinned it on the Turkey news. Then it was fixed yesterday. And now all of a sudden today the market's down again, whether it was down on Turkey or some other related news event or unrelated news event. I don't know. We'll let each individual trader and investor decide for themselves what the reason was that the market may or may not have been down today. It really doesn't matter that much. It's not important. What matters is price. Price is the absolute arbiter. Price was down today, and the question is, where is the probability? Where does the probability lie of price going next? Is it further to the downside, or is it back to the upside? Now, let's make something crystal clear. I still don't think that we're finished with the upside in this market. That doesn't mean we have to go up tomorrow, and it didn't mean we have to go up or should have went up today. I don't think we're finished with the upside. It doesn't mean we can't have another corrective move or pullback first. My point is that I don't think the final leg in the market has completed. I don't think it's over. I still think we're still in the midst of a longer term bullish uptrend. That trend is still our friend. It still has not been broken. Even on the daily chart, if we see some down days, some backing and filling, call it what you will, that doesn't necessarily damage the longer term uptrend. So where are we on the daily chart? Well, the same thing we discussed last night holds true. 279.16 is an important number. If we come down and visit in and around that number, intraday, we can certainly spike beneath 279.16, or we can come up short of it on the other side. We could come up short of 279.16 and make a low somewhere north of that. Either way, as long as we're closing, and this is daily closes, as long as we're closing above 279.16, then this market is still fine. And based on the daily chart, we're still going to call that still in the midst of an uptrend. Remember, here's a picture of the weekly chart. Remember, the 20-week moving average is home base. 20-week moving average is significantly below price. We can come down toward the 20-week moving average, towards home base. Or we can also go sideways and let home base on the 20-week or the weekly chart, the 20-week moving average, we can allow home base to come up toward price. Either way, that doesn't necessarily damage in the least bit the uptrend. On the weekly chart, this uptrend is firmly and fully intact. Let's go to the flip side for a second and take a look at the hourly chart of the Spider. Now, I want to bring us back to something we discussed last night that brings up a different issue altogether. And this is not meant at the masses, it's meant at a select handful of people. But here's what we discussed last night. So the market was the Spiders were making a bullish pattern, consolidating underneath a breakdown candle high. Now, we've seen this take place dozens, hundreds, maybe thousands of times. If the market consolidates underneath an area that it's having trouble getting or can't get through right away, that's its way of building energy in order to get through that particular resistance zone or, on the flip side, support area. So for whatever the reason, I had somebody interpret what I said as the market was going higher because it was making a bullish pattern, and they must have interpreted that as I said the market was going higher this morning, sent me a pretty nasty email about it, and when I asked politely to be taken off his email list, he came back with some more profanities. So that person is now banned from making comments on this YouTube channel, and they've been sent permanently to the junk mail folder, as you can imagine. The point is that you have to be careful and not hear other than what I'm saying. We can't always just hear what we want to hear. I never said the market was going higher first thing in the morning. What I said was the market was making a bullish consolidation pattern the majority of the afternoon, building energy to consolidate and get through that top of that breakdown candle high. That doesn't mean it will. That means the majority of the time, that's what's taking place. I'm calling balls and strikes. I'm an umpire. I don't know that the market's not going to gap down 20 or 30 handles the next morning. That happens. It happened today. I'm not suggesting I was right, wrong, or indifferent. I was just telling you at the time, based on yesterday's activity and yesterday's close, what I was seeing on the charts. Now let's fast forward to today. What am I seeing on the chart? What I'm seeing on the hourly chart is two things. We always want to look at both sides of the market. On the flip side, on the top side, if in fact we're able to get above and close hourly above the top of this breakdown candle high, that would be bullish for this market, and that would likely bring higher prices ahead. However, until and unless that happens, this is a down move and a bearish wedge pattern, and this will likely bring, until and unless we can close above the high of the breakdown candle, will likely bring lower prices out of this pattern. And if so, where would those lower prices bring us? Those lower prices would bring us somewhere in the vicinity of what? 279.16. Funny how the puzzle pieces tend to come together at some point in time. One steps into the next, because different time frames on the charts tell us different things are ahead in the immediate, near, or intermediate or longer term. And that's why we can look at an hourly chart and come up with the same conclusion where we saw support likely to be found on the daily chart. The hourly chart says, hey, if we don't close above here, then we're likely to come down. And where is that downside target? Just so happens to be the same area we're likely to find support in the daily chart. Funny how that works. Let me pause for a second and just thank everybody once again for participating, making comments underneath the video. Your thoughts are much appreciated. Please keep up the great work. It's helpful to me. It's helpful to the entire community. I love the interaction. Please keep it going. In addition, hit the like button on the video and also share the video with those people you think can benefit from this information. Now, before we talked about the IWM, and that the IWM is, of course, my favorite market leading indicator. And as such, the IWM was leading the market in the downward direction today. On a percentage basis, the IWM was down more than the other markets, minus the NASDAQ composite, but nevertheless, more than the S&P, more than the Dow. So we did get some leading activity from my favorite market leading indicator in the IWM. Now, here's what we've been discussing over the last several sessions. The fact that the IWM was putting in the potential, or was putting in a bearish pattern. So we had a down move and we had a bearish wedge pattern. And we said at least 2 or 3 times, until and unless we can close above the high of that breakdown candle, this is likely going to take us back down in the other direction. Now, there is likely support here, and even if we don't find support there, we're likely to find support around that 162.5. You also have a safety net of the 100-period moving average comes up underneath that. But technically speaking, you see this box. That would complete this particular pattern that's developing, the bearish wedge pattern, until and unless we can close above the high of the breakdown candle. So that seems to be playing out. At least that's what it looks like today. Yesterday, of course, we had a pop back above the moving averages. Trick, trap, fool, and frustrate. Maybe that's what yesterday was. Today, we resume the pattern in the making, and in the Russell 2000 or the IWM, it's of the downward variety. Also, when you look at the VIX, that's not the VIX chart I want. When you look at the VIX, you see that the VIX spiked up pretty good today. So from a low of 1007, I believe, the low the other 1017, that was on the 9th of August. 1017, today's high, let me move this over. Today's high happened to be $16.86. 1017 to 1686. Now, I was left out in the cold on this one. We talked about it last night. I didn't take the trade. I was absolutely, without a shadow of a doubt, sleeping at the wheel, asleep at the switch. I said anytime the VIX gets down with a 10 handle on it, in the 10s, below 10, 10.50, 10.75, $10, it's a buy as long as you give it enough time. You just have to be careful with some of those exchange-traded products that are leveraged. They have a tendency to fall apart overnight, unbeknownst to us, until after the fact. We just have to be careful of those. Trade those on your own risk or at your own risk. There's been an oil one that fell apart, a VIX-related one that fell apart, and maybe even a gold one related that fell apart in the past. I'm not 100% sure, but there has been at least two that I know of that did fall apart over time. So be careful, trade those at your own risk. But my point is, and you know that I like to trade the VIX using call options. If I'm buying the VIX, if I want to play the VIX long, I use call options and I generally give myself enough time. So had I been doing it this time around, I would have bought call options out to, let's say, December or January, something like that. And I would have likely already been out of that trade based on the activity in the VIX through today. I probably wouldn't have even stuck around to today, but you never know. The point is, it left the train station. I didn't have a ticket. I was not aboard. The question is on this chart, do we read anything into the fact that we closed back below the 100 period moving average even after spiking well above or through it during the day? Do we stall out at this double top area, or is this the spike that's going to take us back into the 20s in the VIX? Well, it depends obviously on what the rest of the markets around town do. And if I'm right about the SPY or the S&P 500, and we don't have much lower to go, at least on this move, anything's possible, but I still think we're likely to find at least interim support at the level we discussed before. And just as a refresher, in the spider, 279.16. And if that's the case, then we shouldn't expect much more out of the VIX than right around today's high, maybe even slightly higher, up to these highs over here, 19 and a quarter. Something in that neighborhood. Now, if I'm wrong and we get much wider of a sell-off in the S&P 500 and across the rest of the markets, that's a different story, and we'll have to start talking about other numbers. I don't have that necessarily on the drawing board right now. However, why don't we go back to the S&P and start talking about lower numbers just in case I don't want to leave anybody hanging. 279.16 should be at minimum of intraday support. Where is the next major area of support as it relates to the SPY? Well, there's actually a few different areas of interest. So we notice that the 50-period moving average is creeping up toward that 279.16. There's a very, very important area that coincides roughly with where that 50-period moving average is right now. Has nothing to do with the 50-period moving average. So my point is slightly below 279.16, you have a safety net of the 50-period moving average and another number. We'll just call it, for argument's sake, 278.50. So right in there, there's a ton of support right around that 278.50 to 279 area. Lots and lots of chart support. Let's just say, for argument's sake, we were getting a big fat hard sell and the market went down farther. Where's the next area of major chart support? 275. There's a gap there. The market will be attracted to that gap. The market will fill that gap. It may spike through that gap a little bit. Down to 275 is a likely story, but that gap will also be supportive of the market. And then the last line of defense is right here at 273, where you have 100 period moving average. Now, I'm not forecasting that the market is going to these numbers tomorrow. Please don't misunderstand what I'm saying. What I'm saying is, if 279 doesn't hold, whenever that is, whether it's tomorrow or some other time, I'm giving you the other areas of likely support on the downside to be managed throughout the trading day. Not saying we're going there. I'm saying if, in fact, we ended up with some kind of wide open break lower, those are the numbers that you want to watch out for in the spider. Now, how about the transports? Now, interestingly enough, the transports bucked the trend today. The markets are down, and the transports were down earlier in the day, and they were down pretty hefty. They came down, tested the 20-period moving average. You think that's a coincidence or an accident? They bounced off of it, and we actually closed positive in the transports. What's the takeaway from that? Well, the takeaway, A, can't be negative. Can it be all that positive? It can be somewhat positive. It can be in the positive column. It can't be negative. If we have one of those Ben Franklins out and we're putting positive market developments on the left side and negative market developments on the right side, we're certainly putting the transports on the left side of a positive, definitely not a market negative development. So either way, it's interesting. One of my favorite market leading indicators, my second favorite market leading indicator, can't make a whole lot out of it because at the end of the day it was flat, but I just found it interesting, had every excuse to sell off and decided not to, ended up bouncing off the 20-period moving average instead. It's a puzzle piece. It's on the table. It's a clue. It's a piece of evidence. It's interesting information any which way you look at it. Now, the NASDAQ was down about 1%. Now, we had some of the normal FANG tech stocks and other tech stocks across the board that got hit pretty good today. So it's interesting. You know, we have a couple of things going here on the Qs. From a longer term perspective, when I look at the weekly chart, for example, you can see here that the Qs are absolutely, without a shadow of a doubt, in a very strong, gripped uptrend. Nothing wrong with this chart, nothing at all. The daily movements are nonsensical when you look at the weekly chart. Now, however, we do have a high and a lower high. We did close above this breakdown candle. That's a positive. We talked about that already. But we have a lower high in place. So we, can make a case from a daily chart perspective that I have a couple of different things that are diverging from each other, canceling each other out. I can make a case for that. And it's an easy out for an analyst. It's an easy out saying, well, I'm just going to do nothing because I have one thing that says bullish, another thing that says bearish, so I'll just do nothing and I'll be off the hook. Well, I'm not going to play that game. I'm still going to say that while we can come down a little bit farther in the Qs, I'm still telling you there's nothing wrong with this chart. Even if we come down a little farther, even if we have another day of selling, another couple of days of selling, either way, until and unless we start breaking important levels that we're nowhere near right now, nowhere near important levels that would put a sell signal on the Qs, we would have to come down significantly from where we are, and we would have to close below certain levels. Just looking at this daily chart, that's not a one-day event, and if it was, the market would have gotten absolutely cratered, crushed, taken out behind the woodshed 3 times, and shot 7. So, with that being said, we're nowhere near triggering any kind of long-term sell signal in the Qs. Can we have a corrective move? Yes. Does it damage the long-term outlook for higher prices yet? Still in the Qs? No. No damage done yet. Can it happen? Yes, it can, but it has not happened just yet. The XLF, can we derive any information from the XLF from today? We came in, we tested, touched, and bounced off of the 100 period moving average. Other than that, we really can't derive any solid information that's actionable from the chart of the XLF. What I can tell you is we did put in a sign and a signal of a trend change day, and we also did have a trend change for a specific period of time. I'm going to leave it at that. I'm going to leave the rest of that to the folks that have taken the course at Lazy E Mini Trader. We'll just see how it unfolds over time and whether that proves to be meaningful or not. How about the SMH tonight? The exchange traded fund, SMH, that tracks the Philadelphia Semiconductor Index. Now, the semis, or the SMH, are telling a tale of weakness. We've closed now below all the moving averages. We look to be failing here in the SMH. It's not necessarily a chart that's showing any kind of strength, any kind of money flow into this particular sector. In fact, it is showing money flow out of this particular sector. Now, last night we looked at other sectors, like, for example, retail, consumer discretionary. Those were bullish. They were at all-time highs. The market was up yesterday. All of a sudden, how quickly things change. Has anything changed with those sectors we looked at last night? Here's the XRT, the retail sector. All of a sudden, we have a reversal candle on our hands, down 2.7%. So last night, I show you a breakout. I show you all-time highs. I show you a market that's saying the U.S. economy is in good shape. And today, trick, trap, fool, and frustrate, the XRT is down 2.7%, has a reversal candle, and has likely lower prices to come. Again, folks, just call in balls and strikes. If anybody thinks that I'm immune to getting trick, trap, fooled, or frustrated in any of these markets, please don't be mistaken. It happens to everybody sooner or later. It doesn't necessarily happen to me all the time, but it happens, and I have to chuckle when it does happen. The one time, when is the last time that I talked about the XRT? I bring up a chart of the XRT, which I can't remember the last time I brought up a chart of the XRT. It couldn't have been within the last year. It may not have been ever. I bring up a chart of the XRT. I tell you that it makes the U.S. economy look bullish. Things look good. And we have a 3% reversal day the following session. I mean, you can't make that stuff up. You couldn't write that script and have somebody believe it. Here's a chart of the EEM. Now, I think we brought this up last night, and we were looking at it in relation to the S&P 500. When you look at the weekly chart of the EEM, looks pretty ugly, and you can see here today we had a very, very wide-ranging down day. 2.88%, $1.23. We're below the 100 period moving average. This bearish pattern, or the last leg of this bearish pattern, seems to be playing out. So maybe we get down to the 200 period moving average. That is possible, and I have my eye on something, and I just want to point it out. So I'll tell you exactly what I did, and I'll tell you my theory or what I'm planning on doing, and I'll give you A, my target on the upside, and also B, where I would be wrong on this trade. So let's go back to the daily chart, and I'm going to show you what happened. So today, we put in a little tail candle. It's a sign, a signal of a trend change. It's a pseudo doji candle. It's one of the signals that I teach in the class at Lazy E Mini Trader. So, can you take a trade with a candle that looks like this, with a market that's at lows? Doesn't have to be all-time lows, but it has to be recent lows. Those are the best candles that I like to see. When you see this in the middle of a range, and we've talked about this before, it's not the best looking deal in the world. I like them when they're at recent lows or recent highs on charts. So here's what I did. I take a half a position based on today's activity, today's candle. All right, so towards today's close, I take a half a position in EEM. This is a longer term swing trade. I'm not necessarily, and I'm happy to have this play out in 2 days, but I'm not necessarily thinking it will. When I look at the weekly chart, here's what I did. I took two different things, if you will, and I said I'm happy to have either one of them play out. I'm willing to wait. So number one is this a breakout area? I would say yes. I could certainly make a case that the market consolidated over here in this $41.50 area for a period of time in between here and here. We broke out. We went all the way up past $52. We came all the way back in. What do markets like to do? They like to test former breakout and former breakdown areas. So I figured since that is eventually or is actually happening, we're testing a former breakout area, then I might as well put my money where my mouth is and say, all right, I'm willing to take a position, but I'm also willing to recognize that this weekly chart does look weak, and we just consolidated over the 100 period moving average for almost a couple of months. In fact, the amount of time is interesting in and of itself. Those traders that have taken the course at Lazy E Mini Trader know exactly what I'm referring to. So the fact that we consolidated over the 100 period moving average tells me I wouldn't necessarily be so surprised if we came all the way down to the 200 period moving average, which isn't that far away from where we are. It's less than $2 away from where I entered the trade. Now, I don't enter a trade under normal conditions anticipating to have to watch the stock or whatever I'm buying ride down and add to it later. That's not really the style that I like to trade by. However, it's less than $2 down. It's a major support area. It's another breakout area, right? So I can say, even in this area here, I could say, well, this is beneath the 200 period moving average, but there's a gap over here. So there's another breakout area here. So the market broke up, consolidated, gapped up, come back to fill that gap. Here's a gap window right above it where it coincides with the 200 period moving average. I can make a case. There's a ton of reasons there's going to be support beneath where we are now. So let's say I bought it at $39.50 again. Let's say we spiked the 200 period moving average over the next week or two or three, whatever it is, and I had to buy it again, or I chose to buy it. Don't have to do it. I chose to buy it again at $39.50 for argument's sake. Where's my average cost? $40.50. I'm out of the money by $1 average cost, and I own it where there should be, under normal market conditions, a lot of chart support. I'm willing to wait. I'm going to get $1 or more out of that trade under normal conditions based on that type of support in that zone. And that's the philosophy, the theory, the mind setup. Again, it's a look into my mind setup as I analyze real quickly, and all that happened within, a short period of time. I'm thinking about it. That's what went through my mind. It's a look into my mind, which, as you know, is a dangerous place to be, but a look into my mind as I contemplated getting into this EEM trade. Think about it, folks. We want to buy stuff when it's on sale. We don't want to buy stuff when everybody wants it. We want to buy it when nobody wants it. We want to sell stuff when everybody can't get enough of it. That's when we're going to get the best price. It's how supply and demand works. We get the best price for something when nobody wants it. We get the best price selling something we already have when a lot of people want it. And that's the way supply and demand works. And unfortunately, most people don't trade and invest in markets in that manner. They end up doing the opposite because it's based on emotional response rather than logic and common sense. How about gold? Gold, again, taken out behind the woodshed, down about $19. I can't tell you enough. We were just calling balls and strikes. I kept saying, just let it go, let it fall. I couldn't pick it up on the short side. It was going lower. I wanted to tell you it was going lower. I almost told you in so many words it was going lower. We talked about 1200. Then we talked about 1185. Here we are at 1181. Could we get to 1150? Absolutely we could. You just can't short it after it's down this much. It's not possible. It's not the prudent thing to do. You just have to let it fall and wait for gold to give you this signal, or to give everybody the signal of a high volume reversal day. This wasn't it. We may reverse tomorrow, we may not, but I don't see anything yet on the chart specifying this is any kind of a high volume reversal signal. Leave it alone. Crude oil. Again, this bearish pattern plays out. The 66.80 doesn't hold. It finally gave way. And what's interesting was, and I just want to do a quick recap before we give a total cap for the night, which is trick, trap, fool, and frustrate. So we had the infomercial high, 69.95. Crude oil closes above it by a few pennies one time. All right. Takes my bearish pattern, at least the way I look at, view, and trade in the markets, takes it off the table. Obviously, we come down all the way, and they give the whole Monty, right? It's the full-fledged bearish pattern playing out. So, trick, trap, fool, and frustrate. I do nothing. The market reverses the next day. We give the full Monty, get stalled out by the 66.80, go sideways for 4 or 5 days. Now we have another $2 down day. Where did we come to? Right where we said we would if we broke down further. We talked about it last night. We came right down to here. Another gap, big breakup candle low, gap fill. In fact, what's the official low today? The official low is 64.51. This gap, 64.62. There you have it. We filled the gap, and that's the end of it, folks. So we should be at somewhat of at least short-term support in crude oil. Don't be surprised to see it down by the 200-period moving average. There's nothing to do right now on the long side. We have to wait for sign and a signal of a trend change in order to do something on the short. What did I say? Short side, long side. I'm confused. I'm out of wind. I'm running my words together. Let me start over with the last thing I said, which is you can't do anything on the long side. We have to wait for a sign or a signal of a trend change. You can't do anything on the short side because it's down too much. The short was already up when we got near the hot zone. There was another short possibility when we had the bearish pattern, and we just did, or it did, a trick, trap, fool, and frustrate, closed above, at least from the way I trade and look at and view the markets. I took that short possibility off the table. The next day was a reversal, and that's all she wrote. And with that, folks, I'm going to give it a wrap here. It's everything I wanted to and intended to discuss. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.